if the market was completely wiped out and that price to earnings chart that I just showed a minute ago was down at 10 or below, we might very well be near 100% stocks. That's the point. But because of where we are, we have ever-present crash risk, something really important to think about. So therefore, we really don't want to be exposed more than about 30 or 40% here, because we don't know when the market's going to turn over hard, and we can't 100% hedge that move. So you as an individual investor, if you're an individual investor, you've got to think about how much risk you want to take. If you accept that valuations are obscene, then you may want to take, again, from the top down, a small risk profile. Hello, everybody. It's Mike Preston at New Harbor Financial Group. It is Wednesday, May 1st, 2024. It's just after the close here, just after 4 o'clock Eastern time. And we'd like to come out here every week. And the purpose of all of this is to give you some data and some insight. Hopefully, you can understand a little bit more about the financial markets. Hopefully, you can understand a little bit more about how New Harbor thinks. If we can give you a couple ideas that you can use on your own, or even give you some ideas that help you feel better about the markets or about what you're doing with the markets, we're happy. That's our purpose. Please subscribe. Please subscribe to our channel, New Harbor Financial. We're happy to see our subscribers growing. We're very grateful for it. So please do subscribe, click the like button. And also there's a little bell there that tells you about notifications for new activity. We try to put out at least a couple of videos every week, and our viewer base is growing, and we're very grateful about it. Lastly, reach out to us. Our website is newharborfinancial.com. There's a contact us link. It's also down in the bio below. Reach out to us. We'd be happy to speak with you, whether you're a client or not a client. So today I want to talk a little bit about portfolio construction. It's really not going to be an all-exhaustive discussion because I want to keep this relatively brief. This is just going to be covering the treetops. It takes a long time to really develop a viewpoint, a personality, an expression of how you want to build a portfolio. I'm going to be talking a little bit about how we think, how we build a portfolio. But really, this is about you and how you would build a portfolio. I'm assuming that a lot of you watching this, you're going to be looking to build your own portfolio. And I'm going to give you some tips. Again, it's not going to be exhaustive, but based on the years that I've been doing this and the experience that I've got, I can share some pointers that I think can be very helpful. So if you're feeling confused or scared or overwhelmed by what's going on in the world today, this fourth turning that we're barreling through, this everything bubble that seems to never end, you're not alone. This is just a crazy world with a very unique time that we're living through. All times are not equal in the financial markets. This is one of the very, I think, more extreme times that any of us will ever live through. For those of you that know about a fourth turning, we are in the climactic phase of a fourth turning. Probably the next 5 years, we'll see the resolution of that. And not all times are equal. A lot of times you can see years or even decades go by where risk is somewhat muted. And then there's other times where risk is really compressed and focused into a short period of time. And we think that's the period of time we're going through right now. So you're not alone if you feel scared by all of that. To the extent that we can help you feel a little bit better, I feel good about that. So thanks for watching. Now, on to the topic, basic portfolio construction. The first thing I want to say is if you're managing your own money, and a lot of you are and doing it very well, the way that you're managing a portfolio is an extension of you. The stock market, what's really cool about it and why I fell in love with it back in the 90s is that the stock market is an infinite environment. So it's an infinite environment because there's an infinite number of ways to express yourself through investments in the market. You can build a model, but you've got an near infinite number of combinations and possibilities. This is really cool, but it's also really scary. And ultimately, what you get to as you build a portfolio and build rules around the portfolio is an extension of your personality, and it's you expressing your viewpoint in the infinite universe in a finite way. That's the way that I like to look at it. I think it's the truth. It's very psychological. The market's very psychological, driven primarily by psychology and emotions, especially in the short term. So your portfolio should be an extension of your personality, your viewpoints, and your beliefs. Really, it should also be based on what the opportunities in the market are too. Really, one of the most important things to do is to try to separate yourself from emotion. How do you do that? It's not easy. You do that with rules. You do that by experience. You do that by making mistakes. What I'd like to describe here, again, is just a brief overview of how you might be able to start putting that together, and a little brief overview of how we think. So first, I'd like to talk about the top on down. In my opinion, you have to first think about the big picture. You have to have a point of view. You have to have that. That's based on data and that's based on beliefs. Now, sometimes those beliefs need to be challenged. Sometimes you can get into groupthink, but it's important to get in touch with your beliefs. You may want to write out a list of statements about your beliefs that kind of make it clear what you think. Our belief is that valuations are very important in predicting future returns in the stock market. We believe that the price that you pay for something is directly related to what return you're going to get from it. Warren Buffett has been saying that since the 60s when he opened his business. And I think that it's pretty well established that valuations drive future returns. That's a little bit different in this modern era where valuations don't seem to matter anymore. But let's start from valuations. Let's just accept that valuations are a key component in what future returns will be. And so therefore, the only thing that we have to look at is valuation metrics and data and decide if we agree in those things. First thing that you want to look at, in my opinion, are valuations, and make a determination about what you think about valuations. Again, assuming that that's a metric that you believe in. It's a metric that we believe in. Let me just warn you, though, valuations are a terrible timing tool, and valuations can stay obscene for a long period of time. However, you have to have something to believe in. You have to have a starting point. So take a look at one measure of valuation. This is put out by our good friend John Hussman, who we respect a lot in this industry. This is non-financial market capitalization divided by non-financial corporate gross value added. This is only one of many different metrics out there that you can look at. This one, according to Dr. Hussman, is highly correlated to following 10 to 12-year returns in the market. And this chart also is from John Hussman. Takes the previous chart that I just showed you, inverts it, and then looks at what the following 12-year S&P 500 returns actually are. It ends 12 years ago because we don't know the data yet for the following 12 years. But if this model is any good, and as you can see, the model is fairly consistent over the last 100 years, except for a couple errors or gaps in the chart. Now, these gaps in the chart happen to be 12 years before previous bubble market peaks. So this, if nothing else, this speaks to the fact that we're in some kind of bubble here. We don't know how it's going to resolve, but if you were to accept that this model means something, it projects almost minus 6% annualized returns in the S&P over the next 12 years. Now that's nominal returns with an S&P yield under 2% or roughly 2%. This suggests that 12 years from now, the S&P will be a good bit below where it is today, if the model is valid. Now, we can't guarantee that the model is valid. I can tell you that the data is good and it has a great track record. But there's other valuation metrics you can look at. You can look at things like the Schiller Price Earnings Ratio. Now, here's a chart going back over 100 years. This metric was created by Professor Robert Schiller at Yale University. It essentially takes price to earnings ratios over the last 10 years, smooths them out, averages them, and indexes them to inflation, essentially. And there's been a few bubble peaks in the last 20 years or so. The NASDAQ blow off top was an extreme example that was very concentrated in a few NASDAQ tech stocks. We had a correction in that bubble, the tech bubble, but we only corrected back to about a 20 Schiller PE. We had the inflation into the housing bubble. That was the great financial meltdown in 2008. That was a minus 64% or so S&P move into the 2009 low. Even that brought us back to only a 15 Schiller PE. And now we're roughly as high as we've ever been. So we're flirting in the, around in the mid 30s. Don't take this to mean that we have some more room to go. The 2000 peak was very, very concentrated, more so than today. Today we have the everything bubble. What I want you to see here is that the market, even according to this metric, is ridiculously overvalued. And furthermore, that the market was never really allowed to fully correct. I might say that Schiller PE of 10 to 15 is a good 100-year average. We basically dipped to 15, and then the market was rescued by quantitative easing and the biggest money printing experiment that I think we'll ever see in our lives. There's many other valuation metrics you can look at. For instance, market cap to GDP. This is the so-called Buffett indicator. This one only goes back to the early 70s or so, the last 50 years, but the stock market cap to GDP has been roughly around 100% for most of the last 50 years. And then after, other than the little peak in the tech bubble here, after quantitative easing, we went on to some kind of permanently high plateau. We touched 200% a little while ago, presently at 180%. For this to not seem hideously overvalued, we'd have to see gross domestic product explode upwards. It's going to be really hard to do because GDP, profit margins, if you take a look at GDP, if you take a look at profit margins of companies in the S&P 500, they're running at around 11% or 11 cents on the dollar. Long term, they're only at 6 to 8 cents on the dollar. Let's call it 8 cents on the dollar or 8%. They're running 50% above that because of the trillions of dollars of deficit spending that the government has done. So valuations, bottom line, are ridiculous. That's what I want to get across here. So what does that mean? You have to think about what kind of exposure that you want to put into the market. I think that right now valuations are about as bad as they've been. Furthermore, you want to take a look at, is the market risk on or risk off? Well, there's a number of different things that you can take a look there. So you might start looking at valuations, and if you accept they're about as bad as they've ever been, then you want to come up with a macro allocation to stocks. Right now, New Harbor is right around 40%. And we've got a lot of hedges in place that I can describe and happy to at any point. We're not 100%. If the market was completely wiped out and that price to earnings chart that I just showed a minute ago was down at 10 or below, we might very well be near 100% stocks. That's the point. But because of where we are, we have ever-present crash risk, something really important to think about. So therefore, we really don't want to be exposed more than about 30 or 40% here, because we don't know when the market's going to turn over hard, and we can't 100% hedge that move. So you as an individual investor, if you're an individual investor, you've got to think about how much risk you want to take. If you accept that valuations are obscene, then you may want to take, again, from the top down, a small risk profile. And so the first thing you've got to think about is, okay, how much am I going to risk? How am I going to populate this portfolio? I would suggest for people doing this out there on their own that they should be 30% or so stocks at most, because I think the S&P 500 will likely lose 2/3 of its value over the completion of this market cycle. So we're at around 40%, but we've got some pretty tight hedges. Think about what type of exposure you want to have. Let's say that you decide on 30%. Well, you've got to decide on how to populate that 30%. We can talk about that in a minute. But luckily here, in the last year or so, we have other alternatives. What are you going to do with the other 70%? Well, with most of the other 70%, I'd suggest that it's hard to get much better right now than 5.2% Treasury bills over the next 6 to 12 months. So anything you do is going to have to beat that to be better. So I would suggest that you think about putting most of that, the rest of the cash or dry powder, into shorter term Treasury bills. Again, valuations determine your equity exposure. Are we at a risk on or risk off point in the short-term market? Well, to tell whether we're at a risk on or risk off is a little harder. There's a number of indicators we follow. We look at breadth of the market. We look at bullish percents, which is a number of stocks on buy signals versus sell signals in various different indices. And so that can help you decide whatever you might use. Moving average crossover, the 50 to 200-day moving average, something like that. So here's a chart of the S&P 500 on a daily basis. You're going to have to determine for yourself what kind of time frame you're working in. If you're a shorter term investor, you might work on a daily basis. If you're a longer term investor, you might use weekly or monthly charts. But on a daily basis, the red thick line is the 50-day moving average exponential. The green line is the 200-day moving average exponential. The other ones are a 10-day on the blue and 21-day on the green. So you can do any number of these things and create your own rules. We don't really use the moving averages here to make decisions. I'm just trying to indicate a point. The bottom line is you're going to have to come up with your own indicators. Let me go to a monthly chart, see if that tells us anything. Well, the market's been in such an uptrend for so long that none of these moving averages would be giving any sell signals, which is part of the problem with moving averages, is that they tend to give late signals or that they're lagging signals. But you may say something like on the daily chart, if the S&P 500 closes below the 50-day moving average, that's a risk off indicator. So let's just go with that for a minute. So here, about a week or two ago, we closed below that. You might say that's risk off. We closed below it here today. You might say that's risk off. I'm telling you that we're in a bit of a mixed bag here. Whatever rules you determine is going to determine how aggressive you're going to be within that allocation that you previously decided that you were going to have. Again, I'm saying that you should be no more than 30 to 40%, giving the valuation that we're dealing with here. Again, you'll have to deal with that on your own and decide. But really short term here, we've got a mixed bag. The S&P pulled back 5%. It bounced 1% or 2%. It's been selling off in the last couple of days with some high profile earnings reports that haven't worked out. There's still some big ones that are coming up in the next week, and this market could easily reverse and hit new highs. In fact, I still have the bias to think that's going to happen. But until we get a strong up move, and you might even say a nice strong close above the 50-day moving average, the very short-term indicators right now are telling us there's a bit of caution warranted. Once you determine whether how much you're going to risk or what your exposure is going to be, you've got to think about what the alternatives are. Again, the 1-year treasury or 6-month treasury at 5.2 is a very compelling alternative, which is why you should think about putting the bulk of your assets there. But for that slice that you're going to start to populate with some of your ideas, you have to build a watch list. A watch list should be an expression of, again, your beliefs and what you think works for you in the market. And I can tell you here at New Harbor, we've got a mixture of how we look at things, both fundamental and technical. I would say that we definitely lean more towards technical discipline. We're looking for strong chart patterns that are breaking out. It doesn't mean they're all that way. There's some pieces in there that are more fundamental and long-term. For instance, our belief in the gold miners, which, by the way, are also performing very strongly technically lately, or our belief still that the long-term bond is going to bounce. That is definitely not a technically strong sector right now, but we've got a fundamental belief in that. But by and large, the vast majority of our ideas are technically strong ideas. And I don't know what it's going to be for you. It could be that you look at balance sheets or you do fundamental research on company financials, or that you focus only on companies that have a book value, or companies that are trading below book value. Personally, over all the time that I've been in this business, I find that a good strategy is to buy good chart patterns that are breaking out. So you can take a look at any number of research tools, things like Investment Business Daily or IBD. That does a really good job of putting out a list called the IBD 50, which shows good, strong charts that are breaking out. It's a discipline that requires you to have a pretty tight risk control because these stocks tend to be more volatile. I'm only saying that as one idea to look for stocks. IBD is pretty good. We also look at pointed figure charts, looking for high relative strength sectors versus other sectors, or high relative strength sectors versus the S&P. I built a list of different investments here. I call them New Harbor ideas. Basically, I want to just show you one way that you can take a look for ideas, and this is to populate your risk bucket, or the amount that you're going to risk in equities. Just bear in mind that your own biases are going to go into what you're looking for. You're going to have to decide if you're a value investor or a growth investor, or if you like strong chart patterns. I personally think that using relative strength analysis, comparing one sector versus others, or even versus the S&P, as is shown on this illustration here, is a good way to go, and then buy good, strong chart patterns. And these are all, for the most part, good low-cost ETFs. None of these should be construed as a recommendation. These are for illustrative purposes only. But this Alerian Master Limited Pipeline ETF, AMLP, that had very good relative strength versus the S&P. That's what's being shown over here. We broke out at 45.50. We've since pulled back a little bit. But this is a really good, strong chart pattern. It's in a sector that we believe in, that being energy pipelines. It has a good yield, 7.28%. And fundamentally, we believe in energy and oil over a long period of time. So this is actually in our portfolio for a small bit. Emerging markets is something that we believe in. The relative strength of emerging markets versus the S&P is very bad, so we can't say that that's strong. But valuations are very good, and here's an example on how fundamentals creep in a little bit into our thinking. The price earnings ratio of emerging markets is way more competitive. It's in the teens roughly, compared to the 30-something that I just showed you earlier. There's been some good breakouts there. This is a diversified ex-China emerging market position. This is also in our portfolio at the moment. We look at individual countries all the time. And, basically we're building a watch list here. Not all of these are in our portfolio. This isn't in our portfolio, but we've noticed that Poland is really strong. In fact, most of Europe is really strong, especially Poland. So we're keeping our eye on that, and as we are a number of other individual countries. What you want to do is build a watch list so that you can take action when you deem appropriate. Maybe there's a big market down day or something like that, or maybe a short-term sell-off in some of these things, and you could start to populate your list. Japan has been very strong. We added Japan to our portfolio on this breakout back here in January at 65. Relative strength had recently started to turn up versus the S&P. That's not that relevant with an individual country like Japan, but this is what you're looking for, something that's proven. We're not looking to bottom fish, and I think that most people should probably try to avoid bottom fishing. Sometimes it works, but for the bulk of your ideas, you should be looking for things that are proving themselves. There's Japan. Taiwan is on our watch list. Nice chart pattern. It's not in our portfolio, it's on our watch list. Mexico's in our portfolio. We like the Latin American countries. Mexico has proven itself, it's in our portfolio. Brazil has actually started to break down. Relative strength has gone down versus the S&P, not as important on individual countries like I just said, but we had some breaks here. We actually reduced our position by half, but we still like Brazil. We'll see if this thing proves itself or if it weakens further. Gold mining stocks, even though I mentioned earlier, more of a fundamental belief over the long term, have one of the better chart patterns out there, and so does gold itself. Nice long basing pattern, a nice breakout, and we're starting to consolidate sideways here. I believe that GDX will likely break this consolidation to the upside and head into the low 40s. India is in our portfolio, a big, massive breakout. Russell 2000, we take a look at all the different sectors, all the different indices, I should say. This is broken out. We've got a small position in the Russell in our portfolio. It's well hedged with options, put options, and what's called a costless collar. So we're managing that position. It's likely that that breaks higher, but time will tell. Semiconductors are on our watch list, but not in our portfolio, so on and so forth. You kind of get the idea. Lastly, here's a bottom fish idea. We were certainly wrong in this. So you can't buy something like TLT, long bonds, on a breakout. And, honestly, it's been a really poor performer. But we've managed a lot of it with options, where our position is only 7.5%. I truly believe that we're going to see TLT breakout up into the hundreds, probably over 120 in the next year or so. But honestly, it's a fundamental belief that rates are going to drop. The Fed is going to pivot, probably after a stock market accident. And the federal debt is just unsustainable at 34 trillion at these rates. And so something's going to happen. The Fed will probably do Operation Twist or something like that. And it should coincide with a meltdown in markets. We may be wrong, but that's a fundamental call. But what I want you to realize is that for us anyway, fundamental calls are not the primary driver. We've got a fundamental belief and a point of view that I described earlier, and then we populate it primarily with ideas that show good chart patterns and good behavior. Uranium has been added to our portfolio recently. We'll see if that breaks out or breaks down. We're watching that closely. Materials, this is a great chart pattern. It's not in our portfolio yet, but this is exactly what you're looking for. A nice base, a big breakout. Healthcare, same thing. That is in our portfolio. Metals and mining has just been added. Software has been added, but it's a little weak, so we'll see. This brings up a good point. One of the last things that you're going to want to think about after you populate your portfolio is, how the heck do I get out of these things? What is your risk control? So it's really one of the last things you got to think about. So there's a nice breakout here at 58. If we trade down to 52 or 51, it's going to be clear that this thing was a failure and it was a fake out. At that point, we'll probably see the relative strength of that sector versus the S&P reverse down and weaken. So almost certainly we would take a stop and admit that we're wrong. There's other ways of hedging a portfolio. For instance, down at 4,900, we have a put option on the S&P for 15% of client portfolios. That would effectively take 15% of the notional value of their account off. That's another way to hedge. So you have to have whatever risk control works for you. The bottom line is you have to have risk control, because no matter what analysis you do, you never know for sure if you're right. So we've been trying to ride this up with the 40 or so percent that we've got, and we've done a pretty good job at it. And we've continued to move this floor up as we go as well. So if we get some kind of crash, 15% comes right off the table because of this hedge. You may also use something like the stop that I just talked about. You may say, okay, well, I'll stop out of this at 52. XLV would be a stop down at 120. URA would be a stop down at 26. So, I'm oversimplifying here because sometimes we don't want to stop just because there was a breakdown. That's why we use options. We want the ability to hold through some short-term breakdowns and recoveries, and that's why we use options here. But that's an advanced degree type discussion that we can talk about another time. So really, to think about what you would do if you're wrong, and feel free to talk with us about any of these ideas. We're happy to jump on the phone and have a chat with you. It takes a long time to really figure out how you want to build your portfolio. Again, it has to do with your personality and your viewpoint. And lastly, if you want to delegate all of that to somebody that you think gets it, or somebody that you think sees things like you see things, that's what we're for. So again, there's down in the bio, reach out to us, subscribe to the channel, put some comments in here. We'd love to see your comments. If you think we're crazy, that's fine. Put that in there. If you like what we're doing, put that in there. We really appreciate that people take time out to take a look at these things. And lastly, I can't tell you exactly what to do for you, but these are the components: your big picture views, your point of view, determine your overall risk parameters, look at the alternatives, populate the risk segment of what you've got, determine what to do if you're wrong. Essentially, that's it, right? Think about what your edge is. Your edge might be options. We know how to use options. Frankly, as a small trader, a small investor, you've got the edge because you can move in and out of the market quicker. But you've got to take that infinite universe down from infinite down to something that really fits you and your personality. So again, please do subscribe, comment here, reach out to us. Again, we're happy to do a free review anytime. And until next time, thanks again. It's Mike Preston at New Harbor Financial.